Welcome to the Deep Dive. We're here to cut through the noise on the latest earnings calls, and today we're tackling Healthcare Services Group, Inc. That's HCSG. Their second quarter 2025 results just dropped.
Yep. And our job is to unpack those numbers, figure out what management's really getting at, and, give you the clear picture on where HCSG might be headed.
Absolutely. It was definitely a quarter with a big headline item that kind of jumps out.
It certainly does. That one-time event really dominates the initial look. But as we get into the details, I think you'll see the underlying business looks pretty solid, and management seems quite bullish moving forward.
Okay, so let's just rip the Band-Aid off then. Let's start with those headline numbers.
Yeah.
Because there's one in particular that really changes the perspective. Revenue came in at $458.5 million.
Right. And that's up 7.6% over last year, which honestly on its own is pretty good growth.
It is, but that strong top line was kind of overshadowed, wasn't it? They reported a net loss of $32.4 million.
Yeah, that translates to $1.44 diluted loss per share. But here's the crucial part, the context you absolutely need. That loss includes a massive $61.2 million non-cash charge.
Okay, and that's tied directly to the Genesis Healthcare restructuring.
Exactly. So if you mentally pull that out, the whole picture looks, entirely different.
That context is vital. Okay,
Yeah.
So even with that charge muddying the waters, cash flow from operations was still reported positive, right? $28.8 million.
It was. Now there's another adjustment there. You need to factor in an increase in payroll accrual. So the adjusted number nets out to about $8.5 million for the quarter.
Got it. But here's what really caught my eye. Despite all that Q2 noise, management actually raised their forecast for 2025 cash flow from operations. That's excluding the payroll accrual change, obviously.
Right. They bumped it up. The old range was $60 to $75 million, and the new range is $70 to $85 million.
So what gives them that kind of confidence right now? Raising guidance after booking such a huge charge. It feels significant.
It really is. I think the takeaway here is management making an aggressive bet. They're not just saying the Genesis hit was a one-off. They're kind of proving it by boosting the cash flow guidance.
Right. It's like they're signaling, look past the charge, the underlying engine is strong.
Exactly. It's more than just confidence. It feels like a strategic declaration. They're saying that overhang they've talked about for years, it's gone. And they expect the market to reevaluate the company based on this cleaner path forward.
Okay, so let's dive deeper into that Genesis situation then. That massive non-cash charge obviously colored the whole quarter. Can you break down what happened and why management seems, relatively unfazed?
Sure. So Genesis Healthcare, a major client, filed for Chapter 11 bankruptcy protection back on July 9th. That's the key event.
But HCSG is still working with them. No disruption.
That's what management stressed. They've maintained the contractual relationship. Services are continuing without interruption, and critically, payments are still flowing for services rendered after the filing.
Okay, so management's perspective is this is a Genesis problem, not an industry problem.
Precisely. They were quite firm on that. They believe the root causes are specific to Genesis, their history, their capital structure, past decisions, and not indicative of broader weakness in the long-term care sector.
And they actually see an upside here.
Kind of, yeah. They framed it as ultimately leading to stronger, healthier client facilities post-restructuring. It brings clarity to HCSG's balance sheet regarding that exposure, and maybe most importantly for the stock, it removes that long-standing overhang that's kind of clouded investor perception for years.
Okay, the financial fallout. We mentioned the $61.2 million non-cash charge. That was pre-tax, hit EPS by $0.65 after tax. And there's a bit more coming in Q3.
Yeah, they estimate another much smaller non-cash charge in Q3, about $0.04 per share. And they said this will effectively reserve the entire pre-petition exposure.
Explain pre-petition exposure and what reserving the entire amount really means for them.
Good question. So pre-petition exposure is just all the money Genesis owed HCSG for services provided before the date they filed for bankruptcy.
Got it. The old debt.
Exactly. And by reserving the entire amount, HCSG is essentially setting aside funds on their balance sheet to cover the possibility that they might not recover that full amount through the bankruptcy process. It's an accounting measure to reflect the risk.
Does that mean they don't expect to get any of it back?
Not necessarily. They did say it's very early days to speculate on recoveries. Bankruptcy proceedings can be complex, but they also pointed out they have experience navigating these situations and are positioned as a key stakeholder. a critical vendor.
Which implies they'll be fighting for their share of whatever assets are available.
You'd have to assume so, yes.
Yeah.
They'll leverage their position to maximize recovery, but for now, they've taken the financial hit on paper.
Okay, so with that big Genesis cloud finally addressed, let's shift to the growth story.
Yeah.
So that was actually pretty impressive, wasn't it?
It really was. Q2 marked their 5th consecutive quarter of sequential revenue increase. So revenue growing quarter over quarter for 5 straight quarters.
And get this, it was their highest rate of growth since the first quarter of 2018.
Yeah, nearly a 7-year high for the growth rate. That's significant momentum.
What's driving it?
Primarily 2 things. Winning new clients and, just as importantly, holding on to their existing ones. High customer retention.
They talked about retention rates.
They did. Emphasized 90% plus retention as being foundational. They mentioned some choppiness post-COVID where maybe client facilities were changing hands to owners they weren't comfortable with, leading to some exits. But now they feel very confident about maintaining strong retention.
And this momentum seems set to continue. They reiterated guidance for the full year.
Yes, they reiterated their expectation for mid-single-digit growth for the full year 2025. And for Q3 specifically, the guidance is a range of $455 million to $465 million in revenue.
But they also hinted at potentially better than mid-single digits, didn't they?
They did. They suggested that current trends could potentially push them into high single-digit growth, maybe even beyond. It's that subtle nudge suggesting things are tracking well, possibly ahead of their official forecast.
Interesting. It suggests the core business is really humming along despite the Genesis noise.
That seems to be the message, yes. Strong underlying demand, good execution on sales and operations.
Okay, let's pivot to costs and profitability, cost of services. That number looked, well, rough. 99.4%.
Yeah, that's an eye-watering number. Basically, for every dollar of revenue, they spent 99.4 cents providing the service.
But obviously that's massively inflated by the Genesis charge we keep talking about.
Hugely inflated. It makes that specific metric almost meaningless for Q2 in isolation. Their actual goal, what they're managing towards for the second half of 2025, is to get that cost of services down into the 86% range.
Okay, that sounds much more sustainable. What about SG&A, selling general and administrative costs?
Adjusted SG&A came in at $44.5 million. That's about 9.7% of revenue for the quarter.
And their target range there?
Near term, they're aiming for 9.5% to 10.5%. Longer term, the goal is to bring SG&A down to the 8.5% to 9% range.
Yeah.
So you see a clear path towards improving operating leverage there too.
Got it. And the segment margins, environmental services at 0.8% and dietary services way down at negative 10.1%. Those were also dragged down by Genesis.
Absolutely. Directly hit by those non-cash charges.
Yeah.
You really have to look past the Q2 reported segment margins to understand the underlying operational health. The second half targets are more indicative.
Okay. Despite all this, you mentioned the balance sheet looks strong.
Remarkably strong, actually. They ended the quarter with $164.1 million in cash and marketable securities. And importantly, their credit facility was basically undrawn. They mentioned some minor use for letters of credit, which is very standard, but essentially they have full access to their credit line if needed, shows very strong liquidity.
And how are they planning to use that financial strength?
Yeah.
Capital allocation.
Their priorities are pretty clear and standard for a healthy company. Number 1 is investing in organic growth hiring, training, sales efforts. Number 2 is potential acquisitions if the right opportunities arise.
And number 3.
Opportunistic share repurchases, buying back their own stock.
Right. And they announced a new plan for that, didn't they? A pretty significant one.
They did. A new authorization to repurchase $50 million worth of their common stock over the next 12 months. And that builds on the $14.6 million they'd already bought back earlier in the year.
So what's the simplest way for us, for the listener, to interpret that $50 million buyback announcement? What's the signal?
It's a huge vote of confidence from management in their own stock.
Yeah.
Plain and simple. When a company commits that kind of capital to buy back shares, it strongly signals they believe the stock is undervalued by the market.
They actually used the phrase unique opportunity, didn't they? Referring to their stock price.
They did. It implies they think the market hasn't fully digested the removal of the Genesis overhang and isn't appreciating the underlying strength and future cash flow potential. They see value where the market might not yet.
Okay, let's zoom out of it now. Look at the broader industry picture. You mentioned the fundamentals are strengthening.
Yeah, the backdrop is really positive for the long-term and post-acute care sector they serve. The biggest driver, honestly, is demographics. That multi-decade tailwind of an aging population is creating sustained, growing demand for these facilities.
Beyond just demographics, what about the day-to-day operating trends?
Also looking good. Occupancy rates are steady, holding above 80% pretty much across the board, different geographies, different types of facilities. That's healthy.
What about staffing? That was a huge issue for a while.
It was, but workforce availability is increasing. That's a major relief for operators. And the reimbursement environment, how facilities get paid by Medicare, Medicaid, et cetera, that seems stable right now. So the core operating environment is solid.
Okay. Now, something that's been getting a lot of political buzz, the One Big Beautiful Bill Act, or ABA. It sounds like HCSG has a, let's say, constructive view, at least for their part of the world.
That's a good way to put it. Obviously, there's intense political debate around the whole bill. But HCSG has drilled down into the specific provisions that affect their clients and their business. And from that perspective, they see some key positives.
Like what? What are the beneficial parts they highlighted?
Okay, three main things. First, a 10-year moratorium on the federal minimum staffing mandate for nursing homes. That's a big deal. Removes a major potential cost burden and operational headache for providers.
Okay, relief on staffing rules. What else?
Second, an exemption for their industry from certain provider tax reductions that are in other parts of the bill. And third, a significant investment, $50 billion, specifically earmarked for rural healthcare markets, which could benefit many of their clients.
So management's take is that these positive elements create near-term strength and stability, and they outweigh potential concerns about other parts of the bill, particularly around Medicaid.
That seems to be their assessment, yes. They believe those other Medicaid provisions, based on their reading and third-party analysis, are unlikely to directly or meaningfully hit their specific client base. Plus, some might be phased in over years anyway.
But they're keeping an eye on it.
Oh, absolutely. They stress they remain engaged and are ready to adapt if policies do change in unexpected ways. Nimble is the word they used.
Makes sense. Okay, let's quickly touch on their core strategic priorities. They outline 3 pillars.
Yeah, pretty straightforward, but important.
Yeah.
Pillar 1, drive growth. Pillar 2, manage cost. Pillar 3, optimize cash flow.
Can you give a couple of concrete examples for, say, driving growth and managing costs? What are they actually doing?
Sure. For growth, it's things like developing their internal pipeline of managers, converting leads from their sales funnel, and, as we discussed, retaining that existing business. Very operational.
And managing cost.
That comes down to execution in the field by their operational teams, making sure services are delivered efficiently, and also just prudent spending decisions at the corporate level.
And optimizing cash flow involves things like collecting payments faster, better contract terms.
Exactly. Increase payment frequency from clients, enhancing contract terms where possible, and just disciplined management of working capital, things like inventory and receivables. It's all about making the financial engine run smoother.
Got it. What about inflation? Specifically food inflation, which must be a big input for their dietary services. How do they handle that?
That's a key question. They actually have a pretty strong position here because their contracts typically give them the right to pass through cost increases to their clients.
Wow.
It's a built-in safeguard.
So they're protected contractually. But do they try to manage the costs too?
Oh, definitely. They actively use mitigation strategies, things like smart menu planning, adjusting menus based on ingredient costs, and leveraging their clinical dietitians to find efficiencies without compromising quality or nutritional value.
And the actual inflation numbers weren't too bad in Q2.
Relatively speaking, no. Overall, CPI was up 0.6%, same as Q1. But food at home inflation, which is more relevant for them, actually slowed down. It was only 0.2% in Q2, down quite a bit from 1% in Q1. So the pressure eased a bit there.
Okay, good context. Now let's talk about some of those untapped growth opportunities that sound really interesting. The cross-selling potential in dining services seems huge.
It really does. They mentioned their new business pipeline is pretty evenly split between environmental services, ES, think housekeeping, laundry, and dietary services.
But they prefer to start with ES and then add dining later. Why?
Because the dining contract typically brings in about twice the revenue on a same-store basis compared to just an ES contract. So once they have the relationship established with ES, adding dining is a major revenue boost for that facility.
And how much room do they have to grow there within their existing client base?
A lot, apparently. They stated they're still only about 50% penetrated in providing dining services to their current ES customers.
Wow, so half their housekeeping clients aren't using them for food yet?
Basically, yes. It points to substantial demand right within their existing footprint. They said the demand for that cross-sell is unbelievably high.
That's a powerful internal growth lever. What about new markets? They mentioned the educational segment.
Yeah, schools, colleges, it's still small, less than 5% of total revenue. But the interesting thing is the performance. It's showing remarkably positive returns over the last 3 years, strong growth rates.
Why is that segment working well for them?
Management sees a lot of similarities to their core healthcare market. It's fragmented. Lots of potential clients are still handling these services in-house, meaning there's an outsourcing opportunity.
Yeah.
And HCSG's value proposition efficiency, cost savings, expertise apparently resonates well there too.
So it's a nice complementary growth area, diversifying beyond healthcare a bit?
Exactly. Fits well within their overall 2025 growth strategy.
Okay, fascinating stuff on the operations and growth. Now let's shift gears to our regular segment.
Yes. Time for the This Is Not Financial Advice segment. And let me be crystal clear. This is purely a speculative thought experiment. It is absolutely not investment advice or a recommendation. Just kicking around an idea.
Understood. Disclaimer, front and center.
Yeah.
So what's the outrageous but plausible trade idea for HCSG this time?
All right. So consider going long Healthcare Services Group common stock, HCSG, with, let's say, aggressive conviction.
Okay, going long isn't that outrageous on its own after what we've discussed. What's the outrageous but plausible angle?
The angle is anticipating a rapid and significant re-rating of the stock's valuation multiple. The plausible part is based on what we just talked about. The Genesis overhang is now definitively removed, cleaning up the story. Management is signaling strong confidence by accelerating share buybacks. And the underlying cash flow generation looks robust, with raised guidance.
So betting on the market, quickly catching up to this improved reality.
Exactly. Believing the market reprices the stock significantly higher, faster than maybe consensus expects, now that the big uncertainty is gone. But here's the outrageous kicker.
There's more.
To amplify the speculative nature, you could theoretically pair this long HCSG position with a highly speculative short position, maybe using options, maybe shorting a basket of stocks, specifically targeting publicly traded long-term care facility operators or REITs in that space.
Okay, targeting ones that haven't shown HCSG's kind of balance sheet strength or operational resilience.
Precisely. It would essentially be a pairs trade, betting on HCSG's specific strengths, their balance sheet, their service model, management's execution, allowing them to capitalize on industry shifts, maybe even consolidation, while weaker players in the sector, those with less agile capital structures perhaps, continue to face headwinds.
So it's a bet on HCSG as a winner in a potentially challenging environment for some operators, leveraging their unique position.
You got it. It leverages HCSG's specific situation and management's clear confidence against potential ongoing struggles elsewhere in the ecosystem. Again, purely speculative, high risk, not advice.
Definitely an outrageous but plausible one to think about. Okay, let's wrap this deep dive up. What's the big picture takeaway from HCSG's quarter?
I think despite that big one-time Genesis charge, the quarter actually confirmed that HCSG's underlying fundamentals are arguably stronger than ever. You've got proven leadership, a value proposition that clearly resonates with clients.
A visible business model, strong retention.
And that robust balance sheet, which gives them flexibility. Plus, the industry itself is standing at the front end of that massive multi-decade demographic wave.
Which positions them incredibly well, you'd think, to capitalize on future opportunities.
Absolutely. They seem very well positioned to deliver meaningful long-term value for shareholders, assuming they continue to execute.
So here's a final thought for you, the listener, to chew on. What could the accelerating impact of these demographic shifts really mean for the valuation of essential service businesses like HCSG? Does understanding their embedded, almost utility-like role within healthcare operations change how you think about investing in what might seem like mundane industries?
Something to ponder.
Indeed. And just one last time, remember this deep dive is purely for informational purposes. It is not financial advice. Always do your own research before making any investment decisions. Thanks for tuning in. We'll catch you on the next deep dive.